Okay, for those that are just joining the class, this is the first topic that we are going to treat under financial management. We started about 2 Mondays. Today is going to be the third lecture day on my scope. So we started with cost of capital. I introduced you to cost of capital, the meaning of cost of capital, the importance of cost of capital, and then we'll talk about the categories of cost of capital. Thereafter, we begin to dissect the steps that you need to take anytime you want to compute traditional weighted average cost of capital. During the period in our first day class, we were able to discuss cost of equity, how to calculate cost of equity, and all the other relevant concepts relating to cost of equity. One of them is the concept of cum div, ex div, share price, as well as how to estimate our growth rates. And then in the second lecture day, we talked about cost of preference share, the meaning of cost of preference share, how to estimate cost of redeemable and irredeemable preference share. And then finally, we also talk about cost of debts, the types of debts, including the traded and non-traded debts. So we further want to discuss cost of redeemable and irredeemable. And that's where we stopped in our last class. So today, we are going to have examples just to demonstrate what we discussed last time under the cost of debt. So thereafter, once we are done with the examples, then we proceed to discussing cost of convertible securities. If we still have time, then I may likely introduce you to weighted average cost of capital. So give and take, our class on cost of capital, especially for the traditional work, may end in our next class. All things being equal, so that we have only two scopes. Like we are going to have project specific cost of capital, and then the weighted average cost of capital of the combined as an outstanding scope of the cost of capital. Okay, so let's have example. Let's have examples. I believe I might have done examples under the cost of irredeemable debts. So since I've explained cost of debts, the only example I have to take you is under the cost of debts. All right, so let me see in the material if I have the examples I'm looking for. If not, then we will likely use the golden book to pick the question from the golden book, then we solve quickly. But let me search first. This one has to do with not this one. Okay. All right. I will share the golden book with you. Okay. Let's solve this example. I think this example should be in your material, isn't it? Yeah, yeah. Go to your study material, illustration number 9, Emory PLC. So that's the question. I have another question in mind before, but I will share that one with you. Let me quickly share it now so that we'll be on the same page. Let me quickly share the question. Okay. Okay, and I'll post my WhatsApp. No problem. Please, just 1 minute. Let me share. I'm trying to share the question with you. FM. All right. So I've shared. So that will come much later. But first thing first, let's solve this one. Okay. Let's solve the first one. All right. Ateta PLC, in your own notes, is illustration number 9. Emory PLC. Okay, Emory PLC illustration number 9. Okay. Ateta has a 10% redeemable debenture in its capital structure. The debenture is currently quoted at 106 naira x interest, and it will be redeemed at par in 5 years' time. Okay, so looking at the question, we can see that we are given the redemption dates. Remember, you recall what I told you last time. The cost of redeemable debts is computed as internal rate of return. To do this, you have 2 steps to carry out. The first step is to assume 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV, then another discount rate will give you a negative NPV. Step 2 is to proceed to calculate the internal rate of return using IRR formula. That's what you need to do under the cost of redeemable debt. Of course, this is similar to the cost of redeemable preference share. It's the same thing, except that the cash flow that you are going to use under the debt is different from the one you are going to use under preference share. That's all. It's the same thing. All right. Now, all the concept of the same concept we have on equity as well as a preference share, whereby you consider cum div, ex div. The same thing applies there. So the concept of cum interest and ex interest, all of that you have to consider it as well, because the debenture interest or the interest must have been paid before you calculate the cost of debt. All right. So all those things also applies there. But in this particular question, the examiner has told us that the debenture is currently quoted at 106 naira x interest. That means interest has been paid. So how do I do this? Very simple. All I need to do is to just assume 2 discount rates that will produce 2 opposing NPV. Now, in my example here, you will see that I assume 5% first. Okay, I assume 5%, and I use this 5% to calculate net present value. So I will go to the question. First thing first, I will design my table to calculate the NPV. The first item will be the current market value of the debenture. Okay, the current market value of the debenture will represent the quoted market price. In this question, the quoted market price is 106 naira. And because debenture interest has been paid, I don't need to make any adjustments. And that's why you are seeing the 106 here. If, according to the question, we are told that the debenture interest has not been paid, I cannot use the 106. I will just go straight to the question. I will go and identify the coupon rate. The coupon rate is the same thing as interest rate, which is 10%. So if this 106 is cum int, so I will not use the 106. I would just say 106 minus 10 naira. That will give me 96 naira. So it is that 96 naira I will then use as my current market value. But in this question, because the debenture interest has been paid, that's why we are using the 106 directly, no issue. So discount factor 5% for year 0 is 1. 1 multiplied by 106 is 106. Remember our definition of redeemable debts. We said redeemable debt is the one in which the company is expected to pay annual fixed interest and the principal at the maturity date. So meaning that every year the company will be paying annual fixed interest. Then when the debt matures, the company will pay back the principal that the investors have contributed in the business. So for me to now calculate my NPV, I need to determine the present value of the annual fixed interest. So I will go to the question. Of course, first thing first, I will indicate the annual fixed interest. Then the next thing that will follow is for me to determine the value of the interest. How much interest is the company going to pay? I will then go back to the question. You are told that the company has a 10% redeemable debenture in its capital structure, and this debenture will be redeemed at par in 5 years' time. So this means that the company will pay annual fixed interest from year 1 up to year 5. But because the interest of 10% is constant, 10% of 100 naira will give us 10. Okay? So because this 10 naira is constant, that's why we need to go and calculate annuity factor of year 1 to 5. So annuity factor of year 1 to 5 will give us 4.329. Okay, that will give us 4.3229. All right. So when you do that, you then multiply with the cash flow of interest. 10 multiplied by 4.329 will give us 43.3. You can just round it up, which is 43. All right. Then finally, I need to ask myself from the question, when are we going to redeem the debenture? We are told in 5 years' time. Therefore, at the final year, we need to redeem this debenture. So we have redemption value. How are we going to redeem the debenture? I need to ask myself in the question, how are we going to redeem this debenture? Is it at par, at premium, or at a discount? Examiner has told us that the debenture will be redeemed at par in 5 years' time. So at par means 100 naira. And that's why you are seeing the 100 naira here. All right. The next thing I need to do is to determine discount factor for year 5 at 10%. When you put it in your formula that we have used before, so when you put it in the formula, you are going to get 0.784. 0.784 multiplied by 100. That will give you 78.4. If you like, you can round it up. Okay, so that would be 43 plus 78. That's 111, whatever. So you had everything together. Now, please, like anytime you want to compute NPV, you have to start with a positive NPV. Therefore, you are going to add up the positive NPV, then less 106 naira. Whatever you have thereafter is your NPV. So our NPV is 15.7. Okay, we assume 5% and we got NPV of 15.7 naira. So we then proceed to calculate a negative NPV. We assume 5%, we got a positive NPV. So we need to assume a higher discount rate that will give us a negative NPV. And that's why I assume 10% here. Remember what I told you. Anytime you are calculating internal rate of return, you are the one that will assume the discount rate. Examiner will never give it to you. That's one of the limitations of internal rate of return, because it is subjective. Whatever you assume the discount rate to be is what you are going to use to compute your internal rate of return. So here we assume 10% for the second discount rate. Do the same thing. Our cash flow still remain the same. All right. So all I need to do is to multiply. Since I'm assuming 10%, so discount factor for year 0 at 10% is 1. Then annuity factor of year 1 to 5 at 10% will give us 3.791. Okay, 3.791. When you multiply that with 10, that will give us 37.9. Then the last one is the redemption value. this debenture we will redeem at par at 100 naira. So if that is the case, the discount factor for year 5 at 10% will give us 0.621. 100 multiplied by 0.621 will give us 62. Will give us 62.1. When you add the two together and you less from the cash outflow, we are going to have negative NPV of 6. Now, we assume 5%. We got a positive NPV of 15.7. We assume a higher discount rate of 10%, and we got a negative NPV of 6. The next thing we need to do is to now put this in the internal rate of return formula. That is, we calculate the cost of redeemable debenture using internal rate of return formula. This is the internal rate of return formula we have used in the past. Therefore, A is 5% because A is the lower discount rate, which is 5%. All right. B is the higher discount rate, which is 10%. So we have calculated NPV of the lower discount rate to be 15.7, okay, to be 15.7. NPV of the higher discount rate is negative 6. So when you put it in the formula of internal rate of return, we are going to get 8.62. We got 8.62, all right? When you round it up, that means the cost of capital, the cost of redeemable debenture of this company is approximately 9%. So this is how to calculate redeemable debt. This is how to calculate redeemable debt. So that's simply that. Let's solve the second question I just shared with you. Go to your WhatsApp. Go and pick the question quickly. Remember what I told you in day one, up to last week. This is not the kind of question you are going to see on the day of your exam. All these questions we are solving, they are just to test the principle. This is not the likely question you will meet on the day of your exam. So as we proceed, we are going to be solving the likely questions. But for now, what we are doing is just to explain the concept, okay? All right, let's follow. Because no matter how big is a question, once you understand the concept, you understand the principle to apply, you can't do no wrong. You can't get it wrong. And that's why it is important for me to take my time to explain the concept before we begin to dive into the main calculation. All right. So I will stop sharing this so that I can move to the working notes. Or before I switch, let me read the question. All right. So like I said, go to your WhatsApp and pick the question I just shared with you. This is the same question you have there. All right. Ronaldi PLC. Okay, let me even know if you guys are with me. Let me look. One of you should read for us. Who is helping us to read? I need one of you to read for us. Who is helping us?
Ronaldi PLC has an 8% redeemable debenture currently quoted at 103 naira as at today, 28 December 2018. The debenture will be redeemed at par on 1st January 2022. The company has a policy of paying debenture interest every 31st December. What is the company's cost of debenture? If 1, the company is not liable to pay tax. 2, the company tax rate is 40%.
Yeah, thank you. Thank you very much, Joshua. Yes, that is the question. So examiner is asking you to calculate cost of debenture if the company is not liable to pay tax and if the company tax rate is 40%. When you look at this question, you will notice that we are given tax rates, right? So if you are given tax rate, the way you are going to calculate your cost of redeemable debt is different from the way you will calculate when there is no tax. Now, first thing first, before you begin to solve this question, you need to ask yourself, what kind of debenture is this one? Is it redeemable or irredeemable? You will recall in our last class, in my explanation, I mentioned to you that the fact that examiner call it redeemable debt does not make it redeemable. What makes it redeemable is if you are given the redemption date. So if you are given the maturity date or redemption date, then you can confirm that it is a redeemable debt. But if redemption date is not given, you are going to treat it as cost of irredeemable debt. So as far as this question is concerned, examiner told us that today is 28 December 2018, and the company has a policy of paying the debenture interest every 31st of December. Not only that, you are also told in the question that the debenture will be redeemed at par on 1st January 2022. So if today is 28th of December 2018, and you are supposed to, and this debenture supposed to be redeemed on 1st January 2022, how many years do you have? So you now begin to count it. Remember, before you can recognize a year, you have to count 12 months. So from 28th December 2018, how many years do you have here? You will see that 28th December 2018 is already gone. It's not part of it. 2018 is not part of it. So you begin your counting from 2019. So we have 2019, 2020, 2021, 3 years. 2022 is not part of it because 2023 is just 1st of January. Remember what I told you, you have to count 12 months before you can recognize a year. So 1st of January 2022 is not up to a year, just 1 day. Therefore, the maturity dates of this debenture will be in the next 3 years. So if that is the case, and you are told, another thing you need to identify from the question is that examiner has told you that today is 20th of December 2018, and the company has a policy of paying debenture interest every 31st of December. So if today is 28th of December 2018, and that means we have not reached 31st of December. So in that case, the current the interest has not been paid. So in this question, interest has not been paid because the company paid the interest on the 31st of December, and today is 28th. So that means they've not paid the interest. So if they've not paid the interest, that means the share price given to you, this share price of 103 Naira is cum its price. This is cum its price, cum interest price. That means that market price of 103 Naira includes interest. So if it includes interest, what are you supposed to do? First thing first, you have to deduct the interest elements because you cannot use cum int price to calculate the cost of redeemable debt. So you have to use X int price. So let me stop sharing this and move to the working note so that we can together solve the question. All right. The name of this company is Ronaldi PLC. So we want to calculate cost of redeemable debenture. So you then say calculating cost of redeemable. We have identified from the question that this is a redeemable debenture because redemption date is given in the question. All right. So to calculate cost of redeemable debenture, we simply calculate internal rate of return. And I told you anytime you want to calculate internal rate of return, you are expected to assume two discount rates that will produce two opposing NPV. First thing first, examiner has told us in the question that where the company is not liable to pay tax, all right? Where the company is not liable to pay tax. So if that is the case, let's first of all start from there. This is Roman figure 1, not A. So I would then say where there is no tax. So where there is no tax, what do? You want to calculate IRR. So to do this, we are going to assume two discount rates that will produce two opposing NPV. Remember, anytime you want to calculate internal rate of return, always start with 10%. We assume we start with 10% because if 10% is positive, you can easily increase to 15% to get negative NPV. If 10% is negative NPV, you can reduce to 5% to get a positive NPV. All right. So let's start with 10%. Then you create a column. We want to use this 10% to calculate NPV. Create a column for number of years, description of items. Then we have cash flow, discount factor at 10%. Let's separate the table in this one, in this example. Then we have the present value. Starting from year 0. Under year 0, we have current market value. In year 0, you have the current market value of the debenture. So I will then go back to the question, how much is the current market value of the debenture? We are told that the company's, the debenture is currently quoted at 103 Naira as of today. And we have identified that this 103 Naira is come-in price because the company has not paid debenture interest. All right, so we need to go and make adjustments. So we then calculate the, let's say this is the, this first page, second page, then third page will be for our working. So working. Working number 1, we want to calculate X int price, X interest price. All right. The X int price is the market price of debts that exclude interest. And that's what you should use to calculate your cost of debt. So to get the X int price, you are going to pick the cum int price, which is 103 Naira. You then less the current, you less the interest. So you less interest. And I will go back to the question, how much is the interest? What's the interest rate given? The coupon rate of this question is 8%. The coupon rate is 8%. 8% of 100 Naira will give us 8 Naira. Remember what I told you. Anytime you are computing this, always ignore the percentage. Use the figure as given to you. So this is 8. 8 minus 103 will give us 95. So this means that the X int price is equal to 95 Naira. Okay, so let's go back. Instead of us to use 103 Naira, we are going to use 95 because the venture interest has not been paid. All right, so discount factor at 10% for year 0 is 1. 1 multiplied by 95 will give us 95. That's the cash outflow. So we have identified from the question that the maturity date of this debenture is in 3 years' time because we counted from 2019 to 2021 and we had 3 years. That means the company will pay annual fixed interest from year 1 up to year 3. All right, so this will be fixed interest. Now, examiner has told us where there is no tax, okay? That means we don't need to include tax. We don't need to incorporate tax. So the interest is 8%. So I'll just put 8 here. No tax. Then we need to calculate annuity factor of year 1 to 3. Okay, for the benefit of those that are just joining us, in case you don't know how to calculate annuity factor, let me give you as an example. Working number 2. Annuity factor. You can call it annuity factor or cumulative discount factor. You calculate annuity factor when you have constant cash flow. So in this case, annuity factor is computed as 1 minus 1 plus r raised to power minus n, all divided by r. Okay, so annuity factor at 10%. Let me write that. Annuity factor at, what's wrong with you? At 10% will be equal to 1 minus R is cost of capital of 10%, so 1.10. N is 3 years. That's the maturity date in 3 years' time. So minus 3 divided by 0.1. Divided by 0.10. So this will give us 2.487. When you use your calculator to get this, so from your calculator, you start from the parentheses, 1.10 raised to power minus 3 equal, then minus 1 equal, divided by 0.1 equal, you are going to get 2.487. So that's the annuity factor. So here is 2.487. Let me rewrite the 8. All right. So we need to multiply. I will then bring down my calculator. 8 multiplied by 2.487 equal, that's 19.896. When you round it up, that will give us 20. That's 20, rounding 20. Then in year 3, in the final year, this debenture will be redeemed at par. So I will then say redemption value. How are we going to redeem the debenture? We are told it will be redeemed at par. At par means 100 naira. Remember, debt is always quoted at 100 naira per unit. So you need to calculate discount factor at 10% for year 3. Again, let me show you formula for discount factor as an example. All right. Anytime you want to calculate discount factor, this is the formula to use. So discount factor is used to calculate, to discount the cash flow for each year. Okay, whenever you want to calculate present value for each year, then you use discount factor. All right. So in this case, my discount factor for year 3 at 10% for year 3. For year 3, let me write out the formula first. Discount factor is equal to 1 plus R raised to power minus N. So discount factor at 10% for year 3 will then be equal to 1.10. 10% is the discount rate raised to power minus 3. So this will give us 0.751. Okay, that will give us 0.751. So let's go and post. So here is 751. You multiply with 100, so that will give us 75. Here will be 75. We then calculate our NPV. NPV is the difference between the present value of cash inflow and present value of cash outflow. All right. So in this case, 95 minus 95, when you add up the positive present value, 75 plus 20 will give us 95. 95 minus 95 will give us 0. Therefore, our NPV is equal to 0. Since our NPV is equal to 0, we have determined our cost of redeemable debenture where there is no tax. Why? Because NPV is the discount rate. NPV is the rate. Sorry, internal rate of return is the rate that equates NPV to 0. We assume 10%, and this 10% produce 0 NPV. It means that our internal rate of return is equal to 10. That's all. You don't need to do any calculation again. Let me put it down for you. Since internal rate of return is the rate that equates NPV to 0. The cost of redeemable debts is the cost of redeemable debt is the 10% assumed is the 10% assumed that produce the 0 NPV that produced 0 NPV. So in this case, you don't need to do anything again. We have our answer is equal to 10%. Okay, so that's that. Then the second part, where there is tax, we are told that where there is tax of 40%, high, where there is tax of 40%. Please, in case you have any question, always raise your hand and I will allow you to speak. Okay, so now there is tax. We are going to make some adjustments. But first thing first, let's design our table. So in this, our example, we are starting with 10% discount rates. Okay. So in this calculation, we are going to use one table to get the same, to calculate for both positive and negative NPV. So here will be the year. We have the cash flow. Sorry, description of items first. Then we have the cash flow. Discount factor. Then present value. We are starting with 10%. Year 0, year 1 to 3, then final year. Let's design our table first. Okay. All right. MPV. Divide this one into 2. This one 2. So we then put in the cash flows. It's the same cash flow we have done before. So CMV, current market value. Current market value is 95 naira after tax. Then we have the fixed interest. Our interest is, in this case, pay attention. In this case, we cannot use 8 naira again because we are told that there is tax. So we need to go and calculate after tax interest. Let's go and calculate after tax interest. Working number 4. Post-tax. You can call it after tax or post-tax interest. All right. The after-tax interest is computed as interest multiplied by 1 minus tax rates. So according to the question, we are given interest of 8%. So this is 8. Tax rate is 40%, 1 minus 0.40. This will give us 8 multiplied by 0.60. That means our after-tax interest is 4.8 naira. All right. So that's that. So instead of using 8, here we are going to use 4.8. We have adjusted for tax. Finally, we are going to have redemption value. Okay, we are told it will be redeemed. The debenture will be redeemed at par. So we need to calculate annuity factor of year 1 to 3 at 10%, which is still the same thing as 2.487 we have calculated before. Then discount factor for year 3 at 10% will give us 0.751. 95 multiplied by 1 will give us 95 negative. Then 4.8 multiplied by 2.487, 11.94, rounding 12. Then 100 multiplied by 0.751 will give us 75. 75 plus 12. Okay, 75 plus 12. That's 87 minus 95 minus 8. Here is minus 8. We assume 10%. We got a negative NPV of 8. Let us assume a lower discount rate that will give us a positive NPV. Therefore, let's assume 5%. So here will be 5%. 5%. 1. So let's calculate annuity factor of year 1 to 3 at 5%. I don't know why my pen is not flowing tonight. It's not glossy. Anyway, we'll manage it. Okay, so let's calculate using the example we have done before, let's calculate annuity factor. So to do this, 1.05 raised to power 3 raised to power 3 minus equal whatever you have in your calculator minus 1 equal divided by 0.05 equal, that's 2.723. So here is 2.723. Please ensure you practice it from your hand. Use your own calculator to try this, whether you get the same answer. All right. So discount factor for year 3 at 5%, 1.05 raised to power 3 minus equal, that's 0.864, 0.864. 1 multiplied by 95 will give us negative 95. 4.8 4.8 multiplied by 2.723 equal 13.07, rounding 13. Then 0.864 multiplied by 100 will give us 86. So 86 from your calculator, 86 plus 13 equal, that's 99 minus 95. That'll give us a 4, positive 4. All right. So we assume 10%. We got a negative NPV of 8. We then reduce our discount rate to 5%. We got a positive NPV of 4. Thereafter, we need to proceed to calculate cost of redeemable debenture. Yes, Edward, talk to me. Edward. I should recap the 4.8. The 4.8, we calculated it now. This is how we got the 4.8. Edward, have you seen it? Is it working? Because interest has not been paid. So since interest has not been paid, you cannot use the 8%. It has to be after tax. And that's why we proceeded to calculate after tax interest, which is interest multiplied by 1 minus tax. And we got 4.8. Do you understand now, Edward? So lower discount rates plus net present value of the lower discount rates. What's wrong with this thing? It's not flowing. So should NPV of the lower discount rates over net present value of the lower discount rate plus net present value of the higher discount rate multiplied by higher discount rate minus lower discount rates. So we assume 10%. 10% is higher. 5% is lower. So here will be 5 plus NPV of the 5, which is 4, over NPV of the lower, 4 plus NPV of the higher, 8. So higher discount rate of 10 minus lower discount rate of 5. Okay, so final answer would then be 4 divided by 12 equal, multiplied by difference between 10 and 5, which is 5, equal, then plus 5, equal, that's 6.67. Our final answer, the cost of redeemable debenture of Ronaldi PLC is 6.67%. You can run this to the final answer. You can say this is approximately 7%. All right. The cost of redeemable debenture of Ronaldi PLC is approximately 7%. You'll recall last week when I was explaining debt, cost of debt, I said that debt is a cheaper source of financing because of tax deductibility benefits. As a result of tax relief, the company will pay a lower cost relative to when there is no tax. When you look at our first calculation, the number 1 requirement you see that examiner told us where there is no tax. Because there is no tax, the company will pay 10%. The company will pay 10%. But now that we have incorporated tax, the company will only pay 7%. So as a result of tax, the company will save 3% on the cost. So that's that. Let me know if you have any question on this. If not, we proceed to cost of convertible security. Let me know if you have any question for me. Okay, Edward, it's clear now. That's fine. All right. In the absence of no further question on this, let's go to cost of convertible. Instead of me to be switching, let me just use this material to explain cost of convertible security. Okay. Cost of convertible securities. That's the next thing we want to discuss. What do you mean by convertible securities? Let's talk about convertible securities before we talk about the cost of convertible. All right. So the convertible security, let me write that. Convertible securities are fixed income securities such as preference shares, bonds, debenture, or loan notes that can be converted to a known number of ordinary shares at a specified future dates. Okay, so that is convertible security. Any security that has the future of convertibility to equity is known as convertible securities. What we are saying is that all these investors, the preference shareholders, the debt holders, they provided capital to the company to finance its operation. They are entitled to return on their investment from the firm. Now, the agreement between the two parties, between the company and the investors, will indicate whether there is future for convertibility, whether the investors can convert their debts to number of shares. For example, all right, as a bondholder, there must be an agreement between the company and the bondholder to say that at a specified future date, let's say, for example, in the next 5 years, all right, at that 5 years, I need to exercise the rights of the convertibility if it is profitable for me as an investor. So this is what is called convertible security. You want to convert your debt to number of shares so that you will become part owner of the business. You become a shareholder. Instead of a debt holder, you become a shareholder. Or instead of a preference shareholder, you become ordinary shareholder. So this is what is known as convertible security. Now, the investors, let me see. Sorry. Okay. So that is that as per convertible security. Then the investors will only convert to ordinary share capital. Investor will only convert to ordinary share capital if it is profitable. If it is profitable. Okay? It will be profitable. It will be profitable only if the conversion value at the exercise dates is higher than the redemption value. Okay. So for this purpose, before we go there, the cost of convertible securities, the cost of convertible security, the cost of convertible securities is calculated as internal rate of return. The same way as cost of redeemable, preference share or redeemable debts. Okay, so anytime you are asked to calculate cost of convertible securities, just go ahead and calculate internal rate of return. It's as simple as that. Go ahead and calculate internal rate of return. It's not difficult. Okay. However, when calculating the internal rate of return, the higher of the higher of the conversion value or redemption value should be selected. So anytime you want to calculate cost of convertible securities, your intention is to calculate the internal rate of return. So to do this, where you normally have the redemption value when you are calculating your NPV, you will replace it with the conversion value only if the conversion value is higher than the redemption value. So that's all you need to do. That's the difference between this and cost of redeemable preference share or redeemable debt. Okay? Now let's talk about, before we do calculation, let's talk about market value of convertible securities. Market value of convertible security. What is the market value of convertible security? The market value, or let me shorten it. This represents the present value of the expected future cash flow that is annual fixed dividend or interest, and the principal discounted at the yield or rate of return on the security. So that is the market value of convertible. Anytime you are asked to calculate market value of convertible security, just go ahead and calculate present value. That's all. Because market value of convertible security is the present value of the future cash flows. The future cash flows are in two. One is the fixed interest or fixed dividend, depending on whether you are talking about preference share or debt. All right. Then the second part of the cash flow is the principal that the investors have contributed. Okay. So you then discount it at the yield. Yield, you can call it yield or yield to maturity or internal rate of return or rate of return on the security. Whichever one you call it is the same thing. All right. Anytime you are talking about yield, it's the same. You are talking about rate of return. Okay. You are talking about rate of return on the security. So that's basically that. And of course, when calculating the market value of the convertible security, let me put it down for you. When calculating the market value of convertible securities, the higher of one, conversion value, or two, redemption value. Redemption value should be selected. Okay, so that's that. So these are the things these are the key points you need to consider or you need to know when it comes to convertible securities. Anytime you are asked to calculate the cost of convertible securities, just go ahead and calculate internal rate of return. However, when you are calculating your NPV, instead of you to use redemption value, you are going to use the conversion value if the conversion value is higher than the redemption value, okay? Because investors will only convert to number of ordinary shares only if it is profitable. If the conversion value is less than the redemption value, investors will not convert because it is not profitable. They will just allow the security to lapse, they will allow the security to mature, and then they will redeem it. That's what they will do. They won't convert it to number of shares because it is not profitable. But if it is profitable, that is, if the conversion value is higher than the redemption value, certainly the investors will be motivated. They will want to exercise their rights of convertibility. All right. So that's that. Then lastly, I also mentioned that in case you are asked to calculate the market value of the convertibles, just go ahead and calculate the present value. The same way you normally calculate NPV is the same way you are going to calculate your market value. The only thing is just that you are not going to include year zero in your calculation, because once you include year zero, that means you are calculating NPV. But anytime you are calculating present value, you don't include year zero. Your fixed interest, you calculate present value for the fixed interest, then you also calculate present value for the conversion value. You add everything together, it will give you the market value of the convertible. So that's it. Let's have some examples under this between now and the next 15 minutes, so that we spend a complete 1 hour to explain the concept of weighted average cost of capital. All right. Let me know if you have any question on this before I switch to have some examples. Okay. All right. So if there's no question, let's go to the study material. Illustration number, which illustration is that? That should be illustration number 15. All right. Let's solve illustration number 15. Open to your material at your hand. Let's solve illustration number 15. 15. What do you have there? Yes. Go to your material, page 48. Page 48, illustration number 15. Singapore Limited. Singapore Limited. Okay? Singapore Limited. So who is helping us to read this? Yes. Who will help us to read?
Singapore
Yes.
Limited.
Thank you, Chidera. Go ahead.
Singapore Limited has 10% convertible debentures with a current market value of 106 naira. An interest payment was made recently. The debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. The shares are expected to have a market value of 3 naira 50 kobo each as at that time. What is the cost of capital to the company for the convertible debenture when company tax rate is 40%, and assuming that the tax payment occurs in the same year that the interest payment arises?
Thank you, Chidera. That is the question. You are asked to calculate cost of convertible debenture when tax rate is 40%. So in this, what are you supposed to do? You want to calculate cost of convertible debenture. What are you supposed to do? Very simple. Like I mentioned, just go ahead and calculate internal rate of return the same way you calculated IRR under the cost of redeemable debt or cost of redeemable preference share. Is the same thing. The only thing is that where you are going to use redemption value, you will replace the redemption value with the conversion value if the conversion value is higher than the redemption value. That's all you need to do. It's the same internal rate of return. All right. So in this case, to solve this question, first thing first, I need to check the current market value given to me. Is it PUM int or X int price? Examiner told you that the current market value of this debenture is 106 naira. and interest payment was made recently, it means that the 106 naira is X interest price. So since interest has been paid, I don't need to make any adjustment. Now, the second thing you need to consider is the maturity date. If the investors, if the debenture holders want to redeem this debenture, when in the future are they going to redeem it? You are told that the debenture will be converted to equity shares in 4 years' time. Okay, the exercise date is in 4 years' time. All right, so that means we are going to calculate annuity factor of year 1 to 4 to get the present value of the fixed interest. Then lastly, of course, in the final year, which is year 4, we need to compare the conversion value with the redemption value. Anyone that is higher is what we are going to use at the final year to get the present value. So let me stop sharing this and move to the working note. No matter how big is a question, all these things we are talking about, the same way you are going to treat it. If examiner likes, they should give you a question of 3 pages. It's the same thing, it's the same concept. All you need to do is to just understand how to apply the concept or the principle in solving the question. You must be able to interpret. If you don't know how to interpret a question, certainly a student will struggle to treat it successfully. Okay, so this is solution to illustration. What's wrong with this thing? Solution to illustration illustration 15, page 48. All right. So examiner is asking us to calculate cost of convertible debenture. I would then say calculating cost of convertible debenture KD. And I told you that when calculating cost of convertible debenture, you are going to calculate internal rate of return by assuming 2 discount rates that will produce 2 opposing NPV. One discount rate will give you a positive NPV. Another discount rate will give you a negative NPV. All right, so quickly, let's do that together. So create a column for year, description of items, cash flow, then discount factor we are starting with 10%. We are going to have present value. Year 0, we have identified from the question that the exercise date is in 4 years' time. Therefore, in year 0, you are going to have current market value of the convertible debenture. Then year 1 to 4, the company will pay annual fixed interest. Annual fixed interest. Then in the final year, which is the exercise date, you are going to the investor can either convert to number of ordinary shares or they redeemed the debenture. So right now, we don't know what it will be. So we are going to leave that place blank until we do our workings to see which one is higher, between the conversion value and then the redemption value. Let me complete the table. Okay. Next present value. All right. So in year 0, we have the current market value of the debenture. So we then go back to the question to go and identify if debenture interest has been paid. The market value of this debenture is 106 naira, and you are told that interest payment was made recently. That means that 106 naira is already X int price. So here will be 106. No need to make any adjustments. Again, we go back to the question to confirm the amount of the interest that will be paid. We are told that 10% convertible debenture, 10% of 100 naira is 10 naira. Therefore, before I put down the interest, I need to confirm from the question if I'm given tax rates. In this question, we have been given tax rate of 40%. That means I cannot use 10. I have to go and calculate after tax interest. So I will do my working here. Working number 1, I want to calculate post-tax interest. Post-tax interest is computed as interest multiplied by 1 minus tax rates. So interest is 10%, which is 10 naira. Tax rate is 40%. 1 minus 40% will give us 60%. So multiply by 10, 6 naira. The annual interest that the company will pay per unit of the debenture is 6 naira. So I will then come here. Instead of 10, we are going to use 6. Now, in year 4, in the final year, which is the exercise date, we need to check from the question, which one is higher between the conversion value and then the redemption value. So let's calculate the conversion value. Working number 2. Conversion value. The conversion value is the conversion value is determined by multiplying the number of shares at conversion dates with the current market price, with the market price at the exercise date. Okay, you multiply the number of shares and the market price at the exercise date. You multiply it together. That will give you the conversion value. So in this case, we are told in the question that, let's go back. We are told that the debenture will be converted to equity shares in 4 years' time at the rate of 4 shares per 10 naira of debenture. The shares are expected to have a market price or a market value of 3 naira 50 kobo each at that time. So that is, at the exercise date, the market value is 3 naira 50 kobo. However, you are going to, the shares that you are going to multiply with the market value will be 4 shares per 10 naira. So in this case, I will then come here. We are given 4 shares per 10 naira. Then multiply by the market price of 3 naira 50 kobo. So when you multiply, 4 multiplied by 10 will give you 40. 40 multiplied by 3.5, that should be 140 naira. Okay? The conversion value is 140 naira. So you need to compare this with the redemption value. So if the investors wants to redeem if the debenture holders want to redeem the debenture at what price? That would be at par. Okay, that would be at par. At par means at 100 naira. Redemption value is equal to 100 naira. Remember, debt is always quoted at 100 naira per unit, except examiner says otherwise. So in this question, even though you are not given the redemption date, you should know anytime in a question you are not told how debt will be redeemed, you are going to assume that it will be redeemed at par. Remember what I told you, debt can be redeemed at par, premium, or at a discount. All right, so how it will be redeemed will be given to you in a question. If it is not given to you, you will assume it's at par. It's as simple as that. Okay, so let's move on. Now, remember what I told you when I was explaining cost of convertible. We need to compare this. You need to compare the conversion value of 140 naira with the redemption value of 100 naira. So conversion value is higher than the redemption value. Therefore, the investors, the debenture holders, will exercise their rights because it is profitable. 140 is higher than 100. It is profitable. So I will then come here. I will use conversion value. Here is conversion value. Conversion value 140. You can say this is working 2. Okay. All right then. So we then determine the discount factor at 10% for year 0 is 1. Annuity factor of year 1 to 4 at 10% will give us 3.170. So use your calculator at your end. You must get the same thing. I don't know why my pen is not glossy tonight. It's not flowing the way it should. I'm struggling to write on the screen. Okay. Now, discount factor for year 4 at 10% will give us 0.683. 1 multiplied by 106 will give us 106 negative. Then 6. 6 multiplied by 3.17 equal 19, approximately 19. Then 140 multiplied by 0.683 equal 95.62. That's 96. So 96 plus 19. 96 plus 19 equal, then minus 106 equal 9, positive 9. We assume 10%. We got a positive 9 NPV. Then let's assume a higher discount rate of 15 to get a negative NPV. All right. Somebody should give me an annuity factor of year 1 to 4 at 15%. Quickly. Annuity factor of year 1 to 4.
2.855.
2.855. Thank you very much. You are a wise student. Then discount factor at 15% for year 4.
0.572.
572.
Yes, sir.
Okay, then. So let's multiply. 106 multiplied by 1 will give us 106. So 6 multiplied by 2.855. 6 multiplied by 2.855 will give us 17, rounding, 17.13. So rounding 17. Then 140 multiplied by 0.572 equal 80.08, rounding 80. So 97, 80 plus 17, that's 97. 97 minus 106 equal minus 9. Minus 9. So we assume 10%, we got a positive NPV of 9. We then increase to 15% to get a negative NPV of 9. We can then proceed to calculate cost of convertible debenture, which is internal rate of return. All right. Lower discount rate plus NPV of the lower over NPV of the lower discount rate plus NPV of the higher discount rate, all multiplied by higher minus lower discount rates. So cost of convertible debenture equal to 10. 10 is lower than 15, so 10 plus NPV of 10 is 9 over NPV of 10, which is 9 plus NPV of the higher, 9. 9 plus 9 multiplied by higher discount rate of 15 minus lower discount rate of 10. Okay, 9 divided by 18, that's 0.5. 0.5 multiplied by difference between 15 and 10, that's 2.5. 2.5 plus 10, that's 12.5. Therefore, cost of convertible debenture, of what's the name of the company again? Singapore Limited. Let me indicate it. Singapore Limited. The cost of convertible debenture of Singapore Limited is 12.5%. So this is how to calculate cost of convertible security. If it is preference share, it's the same thing you are going to do, only that you are going to use fixed dividend instead of fixed interest. Again, you need to compare the conversion value with the redemption value. Whichever one that is higher is the one that will come to this place. That's all you need to do. It's not difficult. No matter how big is the question, the principle remains the same. All right? So let me know if you have any question for me. If not, let's have one more example under this before we go to weighted average cost of capital. All right, so let's have one more example. Let's solve illustration number 14. A different scenario. Illustration 14. Somebody is sending a chart. So can there be a situation whereby there will be variety of interests? Or is it variety of interest? What do you mean by that? Or is it, or it will always be fixed interest? As the name implies, it is fixed interest. You can have different interest rates depending. This may arise under the bond valuation, but as far as cost of capital is concerned, you can't have different interest rates. But when it comes to bond valuation and analysis, you can have different interest rates for different securities. All right, of course, that is possible. But when you are determining your interest, it's always fixed. All right, it can't change. It's not variable. Okay. So like I said, let's have one more example under this before we move to work. Yes, I need somebody to read illustration number 14, still on the same page. So who is helping us to read this? Illustration 14.
Illustration 14.
Okay.
Lacazette PLC. Lacazette PLC has in issue a convertible debenture with a coupon rate of 12%. Each 100 naira unit may be converted to 20 ordinary shares at any time until the expiry date, and any remaining debenture will be redeemed at 100 naira. The debenture has 5 years to run. Investor will normally require a rate of return of 8% per annum on the 5-year debt security. Should the investor convert if the current share price is A, 4 naira, B, 5 naira, C, 6 naira?
Thank you, Joshua, once again. Yes, to solve this question, you must understand the requirements. You must understand what examiner wants you to do. You are to advise whether investors should convert at the current share price of 4 naira, 5 naira, and 6 naira. So to solve this question, you need to ask yourself, what am I supposed to do? Examiner is asking me to advise whether they should convert at 4 naira, 5 naira, and 6 naira. What exactly am I supposed to do? Very simple. To solve this question, two things you are going to do. You want to know whether investors should convert at 4 naira, 5 naira, or 6 naira. First thing first, you must determine the current market value of the convertible debenture. If the investor, if the debenture holders wants to redeem, if the debenture holders want to redeem this security, what will be the current market price? You know, in some of our calculations so far, examiner usually give us the quoted market price. So that quoted market price is what you are going to calculate yourself because it's not given in this question. So you must determine the current market value of the debenture if the debenture holders may decide to redeem it. You keep it on one side. Then the second step or the next thing you are going to do is to then calculate the conversion value. You need to calculate the conversion value at each price. Okay, the conversion value at 4 naira, 5 naira, and then 6 naira. So you then compare the two, the conversion value versus the current market value if the company wants to redeem it. So any price, the price at which the conversion value is higher than the redemption value or is higher than the current market value will be the price at which the investors should convert. That's all you need to do. Quickly, within the next few minutes, let's solve this and that will be end of convertible. Then we'll go to work. Okay. Let me see. Solution. Here is solution. Let me see, this one will contain it. Now, let me use another page. Solution to illustration 14. Still on the same page. That's page 40. I think. Page 48. Page 48. All right. So examiner is asking us to advise whether investor should convert at the current share price of 4 naira, 5 naira, or 6 naira. To solve this, the name of the company is Lacazette PLC. Okay. So you then comment, there are two steps to solve this. There are two steps you are going to carry out. The first step is to calculate the current market value of the debenture if the debenture holders want to redeem the debenture. Then step 2, you then calculate the conversion value at each market price of the ordinary share. Okay, so step 1. Calculate the current market value of the debenture. Remember what I told you earlier today. Market value of debt represents the present value of future cash flows discounted at the yield or rate of return of the security. It's the same thing as preference share. That is, anytime you want to calculate the market value of preference share, the market value of debt, okay, is the present value of future cash flow discounted at the yield. The future cash flow will represent the interest or the dividend that the company will pay, including the principal at the maturity date. So, to now calculate the market value of the debenture, the same way you will normally calculate NPV is the same way you are going to do this, except that you are not going to include year 0, because if you include year 0, it means you are simply calculating NPV, and we are not calculating NPV. We are calculating market value. So cash flow, discount factor. Remember what I told you? I said that the market value of convertible security is the present value of future cash flows discounted at the yield. So the yield, the rate of return given to us in this question is, let me check. We are given rate of return of 8% per annum. Okay, it's 8% per annum. So the yield is 8%. So here will be 8. Okay. Then you now calculate the present value. So like I said, you don't include year 0, because once you include year 0 when you are calculating present value, it's no more present value. That's NPV. So I would then go back to the question, what's the exercise date on this debenture? According to the question, you are told that the debenture has 5 years to run. All right, the debenture has 5 years to run. So the company will pay annual fixed interest from year 1 to 5. So this is the first cash flow. Fixed interest. Then at the exercise dates, which is year 5, this debenture will be redeemed. All right, will be redeemed. So this will be redemption value. Okay. The interest, according to the question, the coupon rate is 12%. So since we are not given tax rate in the question, so we are going to use the 12% like that. So 12% of 100 naira will give us 12 naira. So how do we redeem this debenture? Is it at par, as premium, or at a discount? You are told that the remaining debenture will be redeemed at 100 naira. 100 naira means par value, that's at par. So here will be 100 naira. So I need to calculate annuity factor of year 1 to 5 at 8%. What do you have there? Somebody should give it to me. Annuity factor of year 1 to 5.
3.993.
3.993. Discount factor at 8% for year 5. Yes.
0.681.
681. So let's multiply to get the present value. So here will be 12 multiplied by 12 multiplied by 3.993 equal 47.92, rounding 48. Then 100 multiplied by 0.681, this will be 68. That's it. You then add it up. So like I said, anytime you want to calculate present value, simply go ahead, you want to calculate market value, simply go ahead and calculate the present value. Present value is the same thing as market value. Market value is the same thing as present value, however you want to put it. Okay. So this will be 116 naira. This is the current market value, that is the present value of this debenture. The market value of the debenture is 116 naira. Now, to now advise whether the investor should convert at 5 naira, at 4 naira, 5 naira, or 6 naira, you need to calculate the conversion value. So step 2, calculate conversion value. So how do you do this? To get the conversion value, you need to go back to the question. How are you going to exercise your rights? How many number of shares? So you multiply the number of shares with the share price. Okay? With the share price, that will give you the conversion value. So you say number of ordinary shares that you want to convert to, you multiply with the share price, that will give you the conversion value. So we are told, according to the question, that 20 shares, 20 ordinary shares at any time until the expiry date. Okay? So you want to convert 20 ordinary shares. So here will be 20 multiplied by, let me put naira sign. So 20 shares at 4 naira, that will give us 80 naira. 20 shares at 5 naira will give us 100 naira. 20 shares at 6 naira will give us 120 naira. That's all you need to do. That's all you need to do. So the next thing you need to do now is to then advise. You will notice that at 4 naira, the conversion value is 80 naira. 80 naira is less than 116 naira, the current market price. So that means the investor will not exercise their rights. At 5 naira share price, the conversion value is 100 naira. 100 naira is below the current market value of 116 naira. Again, it is not profitable. Therefore, investors will not convert. At the share price of 6 naira, conversion value is 120 naira relative to the current market value of 116 naira. So, because conversion value is higher at 6 naira market price, is higher than the current market value of 116, investor will exercise their rights. So let's put it down. Advice. investor should not convert at the share price of 4 naira and 5 naira, since the conversion value at these prices are lower than the current market value of 116 naira. That's our reason. However, investors should convert. Investors should convert at the market price, at the share price of 6 naira, since the conversion value of 120 naira is higher than the current market value of 116 naira. That's it. Because at that 6 naira share price, it is profitable for the investor to convert to ordinary share capital. That's the end of the question. So let me know if you have any question for me. If not, we switch. Or I can just use this material to explain weighted average cost of capital. You can open to the material at your end, open to the question, to the study material, so that you can follow through. I will just use this material to explain WAP. And once we are done with our explanation, that will be the end of today's class. Okay. So now, you will recall when we started this topic about 3 classes ago, because today is the 3rd class, we said that there are 4 key procedures that you are going to undertake anytime you want to compute weighted average cost of capital using the traditional method. Anytime you want to calculate or you want to estimate traditional work, there are 4 procedures. The first step is to calculate cost of equity. Step 2, you determine cost of preference share. Then step 3, you compute cost of debt. Then step 4, you estimate weighted average cost of capital. These 4 steps will be calculated depending on whether you have the 4 of them in the capital structure of the company. So if in some instances you may not have preference share, but certainly you are going to have equity and debt. So if you don't have preference share, that means you are only going to carry out 3 steps. So in our explanation so far, our intention is that, okay, you are going to have the 4 of them, and that's why so far we have discussed how to estimate cost of equity, cost of preference share, and now cost of debt. The last step is what we want to discuss, which is weighted average cost of capital. So quickly, let's go into that. Estimating or let me just say weighted average cost of capital. Weighted average cost of capital, WACC. You see, ordinarily, I would have just explained WACC and then move on with solve question, and that would be it. Within a period, within 2.5 hours, I can finish this. I'll just solve 1 or 2 questions that will disappear. But I know that you are going to struggle if you don't understand the concepts, if you don't have the idea of the fundamentals. Certainly, you are going to struggle, and that's why I've been taking my time to ensure that I explain the underlying concept, the principle of each scope of the cost of capital, so that no matter how big is a question, when you see it, you'll be happy to jump to it. You'll be happy to jump at it and solve. All right, because no question is difficult if you understand the concept. So now we said anytime you want to calculate WACC, depending on the information you have in the capital structure. So all those 4 procedures that I mentioned to you, we are going to carry them out. So, but first thing first, like I explained in our first day lecture, I said that examiner will only ask you to calculate cost of capital. So you are at liberty to be able to deduce from the question. You must be able to infer from the question what kind of cost of capital you want to calculate. Is it traditional weighted average cost of capital? Is it project-specific cost of capital, or weighted average cost of capital of the combined activity? And I said that the information in the question will tell you the direction. The question will surely show you the direction that the examiner wants you to, or how examiner wants you to calculate it. The challenge will be your ability to be able to interpret the question or to understand the requirements. All right. So quickly, let's talk about weighted average cost of capital before we begin to talk about how to estimate weighted average cost of capital and the method that you can use. All right. So quickly, what do you mean by WACC? Okay, we can say WACC represents the overall cost of capital of a firm, or overall rate of return of a firm. Okay, it is the average. It is the average cost of a company. It is the average cost of a company's source of finance. Source of finance weighted according to the proportion of each source, weighted according to the proportion of each source of funds in the company, in the company's total pool of capital. Okay, so that's the meaning of weighted average cost of capital. We said that is the average cost of a company's finance weighted according to the proportion of each source of funds or capital in the company's total pool of capital. This is what we are saying. You know, let's say, for example, you are in an ideal capital structure of a company. Let's say we have ordinary share capital of 1,000. We have preference share capital of 200. Then we have debt capital of 300. The total capital available to this firm is 1,500. That's the total. Now, because the company has ordinary share capital, you are expected to calculate cost of equity. The company has preference share capital in its capital structure. You are expected to calculate cost of preference share. Not only that, we're also given debt of 300. That means you have to calculate cost of debt. So you can see the company's total pool of capital is 1,500. What we are now saying is that when you talk about weighted average cost of capital, we said is the average cost of a company's firm. Average cost, the cost of equity is this KE. The cost of preference share is KP. The cost of debt is KD. So we're now saying that WACC is the average cost of a company's firm weighted according to the proportion. That is, all this cost of capital, all this cost of funds, you are going to weight it according to the proportion of each source of finance in a company's total pool of capital. So in this case now, if I want to calculate my WACC, first thing first, equity is denoted as E. If I want to find the proportion of equity, it will be 1,000 over the total pool of capital, 1,500, multiplied by cost of equity. Okay? Again, if I want to find the proportion of the preference share is denoted as P. Preference share is denoted as P. So the value of preference share is 200 over total value of 1,500 multiplied by the cost of preference share that I've calculated. I will do the same thing for the debt. The value of the debt is 300 over the total value in the capital structure, which is 1,500 multiplied by cost of debt. At the end of the day, I will have my answer. I will multiply 200 over 1,500 multiplied by the cost of preference share. I'll put it there. 300 divided by 1,500 multiplied by the cost of debt. I'll put it there. I will then add everything together. That will give me my weighted average cost of capital. And that's why we are saying that WACC is the average cost of a company's finance weighted according to the proportion of each source of finance in a company's total pool of capital. This is what we mean by weighted average cost of capital. Now that you know what WACC is all about, how do you then compute weighted average cost of capital? Let's move to the next page. Estimating WACC. How do you estimate WACC? How do you calculate WACC? WACC can be calculated. WACC can be estimated using market value or book value. Okay, WACC can be estimated using market value or book value. So let's start with market value. Market value. This represents the price determined. This represents the price determined by the market forces. Of demand and supply. Okay. The market value is the most realistic value and acceptable price by the investors. At times, examiner can advise you, can ask you to explain why is market value preferable to book value by investors. This is what you are going to say. Realistic and acceptable price by the investor. This is the most realistic and acceptable price to investors. All right. Okay. When calculating weighted average cost of capital, market value should be used always, except examiner says otherwise. All right. So at all time, you have to use the market value to estimate your work. Okay. So how do you then calculate market value? So let me put it down for you. I'm taking my time to write all of this in your notes on the screen for you because it's not in your, it's an addition to your what you have in your study notes, study material. So this is to enable you to understand what you are supposed to do. Okay? Estimating market value. Calculating market value. So how do you compute market value of equity, market value of preference share, market value of debt? That's what I want to show you. So market value of equity, denoted as E, is computed as number of ordinary shares multiplied by XDIV share price. So which means that all those things that we talked about under cost of equity, CUM-DIV, XDIV, so they also apply here. When you are calculating your market value, you must adjust for CUM-DIV, XDIV. You must adjust for dividend. All right. Okay. Or you can say equity is because at times examiner may not give to you number of shares. So if you are not given number of shares, then you can use share capital to get your number of shares. So in this case, I can say Equity value is share capital divided by nominal price multiplied by XDIV share price. Okay, so that will give me the market value of equity. Then let's talk about how to calculate market value of preference share. Market value of preference share is the same formula as market value of equity. Okay, so market value of preference share is number of preference share multiplied by XDIV share price. Or you can say market value of preference share equal to share capital over nominal value or nominal price of the preference share multiplied by XDIV share price. You can see it's the same thing as, it's the same formula as market value of equity. The difference is just that instead of ordinary share capital, you are going to use preference share capital. Instead of ordinary dividend, you are going to use preference dividend. Then the last one, market value of debt, denoted as D, is computed as the nominal value multiplied by X interest price over 100 naira. So these are the ways in which you can calculate market value of equity, market value of preference share, and then market value of debt. All right. So finally, now, not even finally. Now, I've just explained to you the market value. Remember, I told you that WACC can be estimated using market value or book value. So we just finished explaining market value. Let's talk about book value. Let's say this is A, then B. Book value. This is also known as nominal value. Nominal or face. Let me write it. Nominal or face value. It is the value or figure given in the balance sheets. In the balance sheets or statements of financial position. Okay. So the figures that you have in the balance sheet is the book value. All right. So when calculating WACC, using the book value, ordinary share capital and reserves must be added together. Must be added together to form the proportion of equity. To form the proportion of equity in the company's total pool of capital. So what we are simply saying is that anytime you are asked to calculate WACC using book value, you are supposed to add ordinary share capital and reserves together. You add them together. That will help you to form the proportion of equity. For example, let's say in a company's capital structure, you have ordinary share capital of 1,000 naira. You have preference share capital of 200 naira. You have debt capital of 300 naira, and then you have reserves. You are also given reserves, say 500. When you add everything together, total is 2,000. That's total. Total capital or total value is 2,000. So when you now want to determine, when you want to calculate your WACC, you want to determine the proportion of equity. What we are saying is that to get the proportion of equity, you need to add equity is equal to ordinary share capital plus reserves. So you are going to add ordinary share capital plus reserves over the total value. So multiply by 100. This will give you the proportion of equity. So the proportion of the preference share also will be preference share capital divided by the total. The proportion of the debts will be the debts divided by the total. Multiply by 100 over 1, multiply by 100 over 1. So what we are saying in essence is that when you are using book value to calculate WACC, you must add ordinary share capital and reserves together to form the proportion of equity in the company's total pool of capital in the capital structure. Okay, so that is what you need to do. But if in the question you don't have reserves, if you don't have reserves, then just use only ordinary share capital. Okay, you use only ordinary share capital where there is no reserves. All right, so that's that. Last thing we are going to talk about is how to estimate WACC, the formula for calculating WACC. Okay. The formula below, can be used. Let me see. If I put estimating WACC, okay. The formula below can be used to estimate WACC. So, if you want to use formula to calculate WACC, WACC is denoted as KW equal to equity value over equity plus preference share plus value of debts multiplied by cost of equity plus value of preference share over total value, that is equity plus preference plus debt, multiplied by cost of preference share. Plus value of debt over total value, that is value of equity plus value of preference share plus value of debt. All of this multiplied by after-tax cost of debt, that is 1 minus tax. So this is the formula for calculating weighted average cost of capital. This is this is the ideal formula. But in most cases, the one you have in the middle may not be there. If you don't have preference share in the capital structure, then it will just be this and this alone. So the one in the middle will not be there. All right. So let me define the variables where KW equal to weighted average cost of capital, E equal to equity value, P equal to value of preference share, value of preference share, D equal to debt value. Then KE, you already know that to be cost of equity, P cost of, KP. KP equal to cost of preference share then KD cost of debt. Of course, T equal to company tax rates, company tax rates. Then you can say KD multiplied by 1 minus tax equal to after tax, or you call it post tax cost of debt. All right, so that's that. This is how to calculate weighted average cost of capital. If I don't want to use formula to calculate my work, alternatively, I can also use table. I will get the same answer. Alternatively, work can be computed using the table below, or can be computed as follows. Okay, so to do this, we are going to create about 4 columns. The first column will be the type of the security. We can have ordinary share capital, preference share capital, and then the debt capital in the capital structure. Then after that, determine the value, whether it is book value or market value. Then the cost. We create a column for cost of individual capital that you have calculated. Then you have hash total. So whatever is the value Like I said, whether you are using book value or market value, whatever it is, put it here. This is the total. That's total value. What's wrong with you? Then, so the cost of equity, for example, for ordinary share capital, you have calculated cost of equity, you have calculated cost of preference share, you've also calculated cost of debt. So that's what you are going to put under the cost of capital. So here is KD. To now get the hash total, you are supposed to multiply value with the cost of capital. You get hash total for each type of security. Then, of course, you had everything together. Then you calculate your WACC. WACC is computed as hash total over total value multiplied by 100 over 1. So that's that. Whether you use the tabular method or you use formula to estimate your WACC, you are expected to get the same answer. You must guess the same answer. Okay, so that's that. We are done. We are done with the explanation of weighted average cost of capital. So let me know if you have any question for me. In our next class, by the grace of God, we are just going to be doing calculations. In our next class, I doubt we may not be able to finish in our next class. At least we should be able to solve 4 different questions at a minimum. Okay, at a minimum, we should be able to solve 4 different likely questions. Okay, so let me know once again if you have any question for me. Let me look at your material, study material, in case I miss anything that I've not said. Let me quickly check. Under work, let me see. So I want to be sure I've covered all relevant areas on your traditional work. Okay. So we have talked about all of this. Yeah. The only thing we did not talk about is the assumptions, the underlying assumptions of WACC. Okay. The first assumption is that we assume that the historical proportion of debt, that is the debt equity proportion, will not change, will remain constant. The debt equity proportion, as shown in the capital structure, will not change, it will remain constant. Then 2, the operating risk of the firm will also remain constant, will not be affected. Okay, the operating risk arising from the variability in the cash flow will remain unchanged. Then 3, the finance is not project specific. That is, projects are financed from a pool of funds in the capital structure. Then lastly, we assume that the project is small relative to the company, so that any changes is generally insignificant. All right, any changes we assume to be insignificant because the size of the project is small relative to the size of the company. All right. So what it simply means is that if these criteria, if all these assumptions are not present, then it will not be appropriate to appraise the projects using traditional work. Okay, so that will be that for today. Again, let me know if you have any question for me so that we can close. Any question for me? Do you have any question for me? All right, that's fine. And for those of you that are yet to get your financial management golden book, the SFM golden book, like I explained to you in our first day class, the SFM golden book is a high quality material that is, I can call it 2-in-1 because it's a material designed principally to help you to excel in your financial management and also strategic financial management golden book. I mean, financial management and strategic financial management ICAN exam. So the golden book is specifically designed to address student pain points. Anything you need to succeed in financial management is in that book. And the good thing about it is that you are going to use it at skills level for your financial management exam. You're also going to use it for your strategic financial management exam at the professional level. So if you have it today, if you have it now, you use it, you read it, and you use for your exam. By the time you are preparing for professional level, all those things that you have learned, all those things that you have read in the book will still remain there. Because most of all these things that you are learning now in FM, you're also going to do it when you get to strategic financial management. Therefore, I will advise you get it on time and start using it. The printed copy, the hard copy is 15,000 naira, while the ebook, the PDF version, which I've been showing with you, or the PDF version I've been showing you all this while, is 8,000 naira, and it will expire. Your access will expire on the 30th of June because the access is for every diet. The access to the golden book is for every diet, and it will expire at the end of June. So I encourage every one of you to get it on time and start using it. Okay, it's high quality, exam focused, highly structured learning material. It will help you a lot. It will help you a lot. Okay. Now, yes, Niyi, you raise your hand. Talk to me.
Good evening, sir.
Good evening.
Sorry, please, on that, what's it called, the weighted average, the tabular form, I noticed that there's no tax in it.
No, you
There's
must have
no
just
place.
take it again, Niyi.
I said in the, what's it called, the weighted average
The
tabular form,
tabular format, yeah.
yeah, the format of it, that I don't see any, what's it called, any place where you wrote was the tax, the posters,
The one minus tax.
the one minus tax, yes.
You would, from that formula, from the table I showed you, you see, you have cost of equity. I wrote cost of equity, cost of preferential, cost of debt, Abi. So where you have the cost of debt, you would have adjusted for your tax before you get to that point. When you are calculating your cost of debt, you would have adjusted for tax. So before
Okay.
you get to that table, yeah, don't worry. By the time we begin calculation next time, you will see what I'm talking about. All right?
Okay. Okay, sir.
Yeah. Okay, so in the absence of no further question, I want to say thank you to every one of you. I will see you next week, Monday, by the grace of God. Good night, everyone. Bye-bye.